also of this to solve. You can go ahead. So today's topic is investor and other stakeholders. Investors and other stakeholders. What is this? Let us now take an example. So let's say we are speaking about XYZ company. XYZ company has many stakeholders. I will divide the stakeholders into two parts: internal stakeholders, external stakeholders. Okay, so we will divide the stakeholders into two parts: internal stakeholders and external stakeholders. Internal stakeholders are the one, actually, first of all, who are the stakeholders? The stakeholders are the ones who are the connected parties with the company. So these are the ones who are connected with XYZ company for some or the other reason. They want some benefit, some return for whatever resources they have employed in XYZ company. So that is what that's what stakeholder means. They are the connected parties with the company. So now we will now, as you know, I have given division to stakeholders here. So internal are nothing but the ones who are working in the company, who are internally connected. External are the ones who are not directly connected with the company internally, but are connected externally. That means you yourself can understand the difference. Internal stakeholders are the one who are internally connected in the company. That means they are a part of the organization. They are working in the organization. The board of directors, the employees, the management, and the external stakeholders are the shareholders. So that's what shareholders are, one amongst all the stakeholders. Shareholders, nothing but investors. These are one of the investors. The other investors also, like bondholders, or we can say lenders, which can be a financial institution like bank, or bondholders. And then comes the customers, suppliers who supply the goods to company, government, and then it's not only the government, apart from government, NGOs, pressure groups, etc. Okay, so these are all the stakeholders. Okay, so this is what we have understood about this. So stakeholders, as they are connected with the company, they want something in return from the company. Board of directors, they have promised that they'll make the organization profitable. Henceforth, they want to make the organization profitable, and also they want to maximize the wealth of the shareholders. This is what they promise. Henceforth, they have to deliver. Okay, and every one of them are waiting for the company's financial performance at the end of the year. Employees want job security, safety, hikes, promotion, perks. That's only possible if the company is profitable, and they also look forward for the company's financial statements at the end of the year. Everyone wants to work with a successful management who has successfully made the organization profitable, and whose policies, whatever they have implemented, have turned into success. Okay, the policies implemented have made the organization successful. So henceforth, they are also the ones who look forward for the company's performance at the end of the year. And they are only the ones who emphasize much on financial aspects. Okay, but you know, the trends are changing now. It's not all about the profits, what the investors or stakeholders would be looking at. These people may be much more concerned and much more focusing on profits, but there are certain factors like ESG, environmental, social, governmental or governance. These factors are equally given much more emphasis in today's world. And as you know, like climate change and all, like many countries are meeting on that agenda. They are like signing a lot of agreements that they want to like conserve or preserve the environment what we have. And like today people's perception have changed. People only want to invest in some companies who are doing good for the society, good for the environment, and also are complying with all the rules and regulations. That leads to much more sustainability. Sustainability is what everyone wants. People do not want exploitation from the companies of the environment which belongs to everyone like equally. So they want everything as per the compliance. Okay. So now you will be also learning about all these factors. So then comes the other stakeholders here. Customers are the ones who give much more emphasis to quality. Lenders, they want to reduce their risk as much as they can in the company by seeing that company is following with all the rules, regulations, norms, compliances, and also like company is profitable as well. And so government looks for taxes, and NGOs and pressure groups want company to comply with rules and regulations. This was just a small and general discussion about the stakeholders. Now let's go into the subject. Compare the financial claims and motivations of lenders and shareholders. I think discussed with you the same thing right now. I don't want to discuss again this one. Okay, every stakeholder has some or the other claim from the company. Okay, based upon their claims, the returns may vary. If I tell you who has who are the ones who have the highest risk in the company, those are equity holders, because they are the actual owners and they take the maximum risk, right? So here a company's lenders, debt holders have legal contractual claim to the interest and principal payments of company. Of course, the bond holders, the banks want principal and interest payment. Equity holders wants the share of profit, or the profit belongs to them. That means after settling all the claims, whatever is left over belongs to them. Lenders have a higher priority of claims than equity owners because debt is less risky than equity. It is less costly form of capital. So lenders have a high priority of claims. Why? Because they see from company's perspective, equity holders have the maximum risk. Okay, debt holders have less risk. Why? Because they get the backup of assets from the company. Their security, whatever the security they're holding, have the backup of assets. If tomorrow company goes into losses, they have to sell the assets and give the money to the bond holders. That is not the case from the equity holders perspective, so they have to bear the final losses. So both debt holders and equity holders can potentially lose their entire investment if a company fails, but their losses cannot exceed the amounts they have invested. That's what they are saying. Both debt holders, the one who have invested in the company in form of bonds, and the equity holders, they can lose their investment value. That means whatever the value which was supposed to go up, if it comes down, they can lose their entire investment. But if the company fails, that means company goes bankrupt. But whatever the losses they are incurring, okay, their losses cannot exceed the amounts they have invested. That means if I have invested $100, my loss can only be to the tune of $100, but my loss cannot be more than $100. Yes. Now, a key difference between debt and equity investments is their upside potential. Regardless of company success, best result debt holders can achieve is to receive the interest and principal payment promised by the company, of course. And equity holders, the value of their shareholding can grow up. It can go up. So it over time. That is the benefit what they have. And they also get of company is equal to value of debt plus value of equity. So if you buy an apartment, let's say a flat, which is costing 50 lakhs, in that if you put a 10%, a 20% down payment of 10 lakh, and you have taken 40 lakhs as loan. So your total asset value is 50 lakhs. Your value of debt is 40 lakhs. Value of equity is 10 lakhs. So this makes sense, right? That is equal to the asset value. Now, as the company's value increases, the value of as like assuming its value is greater than the value of its debt, the value of equity increases with it, because while the value of debt is constant, there is no upside for debt investors from company growth. See what happens, only the equity may go up or it may go down. Okay, but the debt holders, bond holders, whoever are the, or let's say company has taken a loan, the value of that loan or debt is going to be the same amount. It's not going to change because you have borrowed that much and you will be redeeming that much. Okay, or paying that much. So the value of stocks or shares only would fluctuate, right? So as the company value increases, if I say the asset value is increasing, definitely this and this should also move, right? But only this one can move up because this one would be basically constant. So as the company's value increases, assuming its value is greater than value of its debt, okay? So company's value is more than the value of debt. So here your company's value is 50 lakhs. It is more than the value of debt by how much? Equity, this much. So the value of equity increases with it, while the value of debt is constant. There is no upside for debt investors from company's growth. If the value of company is less than the value of its debt, the value of equity is zero. That means you understand asset is equal to liability plus equity. So 50 lakhs is equal to 40 lakhs. The difference is 10 lakhs here, correct? So your asset is more than your liability by how much? Your equity, right? Because asset minus equity is also liability. But if they say if the value of company is less than value of debt, if the asset is 40 lakhs and the liability is 40 lakhs, the equity have to be zero. Correct or wrong? Yes, tell me yes or no. Hello.
Yes, sir.
Of course, if the value of company is less than the value of debt, let's say is 30 lakhs and 40 lakhs is the debt. So you know your debt is more than the asset value and equity is almost zero, right? So your company has gone bankrupt. It is in losses. Correct or wrong?
Correct, sir.
Yeah. So if the value of company is less than its the value of its debt, the value of equity is zero, and the value of its debt is below the promised amount and moves with the value of the company. That means now the debt has chance of getting pile up because to survive you have to take more debt or something, right? So the debt has downside exposure. So here, if at all you want to survive, either you have to raise this. Okay. So there is a lot of chance that you may try to raise your equity and try to balance the act. That's what they're saying. Impact of leverage on return on equity. See, leverage can be a very important factor. Okay, and the advantage of or you can only have leverage in one of the cases, that is if you have taken debt finance, because you get more returns because of debt finance. Okay, because the dilution of earnings will be less if the debts are raised. If you are going for 100% equity, there will be more dilution of earnings. That means more amount have to be distributed amongst the equity holders. Now, there's a question. A company with revenues of $1,000 and operating expense of $800. So if you remove this 800 from this, $200 is your profit. Needs to invest $1,000 in assets. So this is the revenue, this is the expense. They want this much for investment. Assets, there are two options. You can either go for 100% equity for buying these assets, or you can go for 50-50, that is 50% debt, 50% equity, right? So $500 equity, $500 debt. So interest rate on debt is 10%. You assume that there is no taxes, generally it is not possible, but here they are saying assume that there are no taxes. Calculate ROE using both financing scenarios. Very simple. We take revenue, we take operating expenses. Okay. In case of equity, there is no interest expense. That burden you may not have. Here also revenues are 100,000. Your operating expense is 800. In case of debt, as you have taken, as you know that you want this much to buy the asset into what is the rate of interest given? Interest rate on debt is 10%. Assume no taxes. Okay, so now we can understand that this 1000, whatever we are taking out of that 500 is equity and 500 is debt, because we are taking 50% debt, 50% equity, and on this 10% will give you 50 as interest. And you know here the net income is more, here the net income is less, right? But here the return what we are checking, we have invested this much as equity and this much as equity. Okay, because 500 is debt, 500 is equity. Now when we check the return on equity, that is 150 by 500, here 200 by 1000 into 100 into 100. 5 months 20. Here you get 20%, and if I calculate this once 5 30%. So you can see here 30%. So in which case you are having much more return on equity? Please tell me. Hello. Hello. Where you have more return on equity?
So where we are having 200 as net income and 1000 as equity.
Here the return on equity is less, right? Here the return on equity is more.
Oh,
What are you
yes,
saying,
yes,
Bharat?
150 by 500, sir. I saw that as 200 by.
No, when you have 50% debt and you have 50% equity, you have more ROE. Why you have more ROE? Because the net income is 150 and the equity is a small amount. Okay, because you have taken the advantage of this interest expense. Okay, if I see the EPS also, let's say there are in this case there are 20 shareholders and in this case there are 10 shareholders. So 1000 by 20, 500 by 10, each one is getting 50. Here what? Here let's say there are like 10 shareholders, but here it is, sorry, the net income I have to take, right? What am I taking? Sorry. Yeah, so the net income is 200 and the shareholders are 20 here. The net income is 150 here and 50% equity. Different scenarios, right? Here the net income will be more, here the net income will be less, but here the shareholders will be less, here the shareholders will be more. Here each and everyone is getting $10. Here each and everyone is getting $15. In this case also you can see here there is more dilution, right? There is less dilution. Why? Because of the leverage what they can get with the help of debt finance. Okay, less sharing of profits because the number of shareholders are less if you opt for 50% debt and 50% equity. Come on, please tell me, did you understand?
Yes, sir.
Yes, this is only going to work if there is an increase in revenues, but if the revenues are decreasing, then what? Let us see. Then you cannot take the leverage of the fixed interest expense. I think this concept I have already given the video of leverages, right? Hello.
Yes,
Did
sir.
you go
You
through the
concept
video
was.
of leverage concept? No, did you go through the video of that leverage concept? I have sent you long time back. Did you see that?
No, sir, I have to go through it, but I remember the concept when you explained it previously.
Okay. I'm finding very much lagging. We have like lagging in case of you people because you're not taking things seriously. I'm really worried about this. Fine. So let's take the previous example once again. Let's see that the same combination 50% debt, 50% equity, and 100% debt, but here the revenues are decreasing. Instead of $1,000 as revenues, now we have only $850 as revenues. So in both cases, I'll take the same thing. I'll remove the operating expense. Here there is no interest expense because 100% equity. Here 50 is the interest expense. So that is eating away your entire net income. Okay, and you have zero ROE. Here 5% at least. So this particular leverage or advantage of fixed interest cost you can only take if the revenues go up. If there is a decrease in revenue, your ROE would decline or your return on equity will go down, or you cannot take advantage of the fixed interest cost, or you have no leverage, right? Describe a company's stakeholder group and compare their interests. I have already explained this to you right now. Each and every stakeholder's interest and everything. Board of directors and everyone. You have a good idea about, right? So shareholders are the ones who are the actual owners of the company. They have the residual interest or leftover, whatever is left over after settling all the claims belongs to them. They have the highest risk in the company. So they want the highest percentage returns because they take the maximum risk. So they want to be compensated with higher returns as premium for the risk what they're taking. And the biggest advantage what they have is being the investors, they get dividends and also their value of the shares can go up. Lenders, they have greater protection than shareholders because they ask for collateral or some kind of security before like they lend the money. So like, these are all preconditions from the lenders. Fine. And lenders can be public or private debt holders. Public, like people, there are individuals who buy the bond of the company, and private are nothing but the banks and insurance companies or who have surplus funds. Private debt holders, have access to non-public information from company management, because see what banks would do is they would ask a lot of details from the company before giving it a loan, and they may ask all the internal information as well, okay, which are critical source of like information because before giving them any kind of finance. But public debt holders, they get less information, okay, but both of them impose lot of conditions on company, like those are called covenants, which would restrict company from taking further loans without repaying their loans, before opting for some more debt finance. Board of directors already explained. Now there are two types of directors: independent and non-independent, or internal. You can know, you can see in the case, you can see that as executive directors and non-executive. Executive or the directors who are working in the company are called executive directors. They work in the company, okay. They are the ones who are involved in all the policy making and day-to-day operations. External directors or non-executive directors or independent directors are also involved in policy making, but they are the ones who are not working in the company on daily basis. Fine, they are not involved in day-to-day operations. So board of directors is responsible for protecting the interest of shareholders. Of course, they have to work for the best interest of shareholders. There's a fiduciary relationship, that is principal agent relationship between the directors and the shareholders. Everyone knows. Hiring, firing, and setting the composition of firm senior managers is what they do. Establishing the strategic direction of firm and monitoring the company's financial performance and other aspects of its ongoing activities is what they have to do. They have to see. Board members include inside directors, senior executive founders, and independent directors who have no meta relationship with the company, while inside directors may have conflicts of interest with shareholders. Yeah, at times what would happen, whenever the company earns profits, shareholders would pressurize the inside directors to invest in risky projects, which they don't want to do because if the company goes into losses, they would be blamed. So there's a conflict of interest between shareholders and inside directors. What shareholders want, inside directors are not listening, right? So there's a conflict of interest. So independent directors may better protect shareholders' interests. Now there are some terminologies here. In a one-tier board structure, both inside and independent directors serve on a single board. That is typical of one-tier board structure. Major stock exchanges specify requirements for director independence, because the directors who are working in the company should be working very independently. Okay, such as that most of the board should comprise independent directors, so that shareholders' interest can be protected in a better way. Other requirements may include diversity of backgrounds and competencies. That means different if the directors whoever are in the board should have expertise skills in different areas. Like someone who is an audit director should have good amount of knowledge in area of audit. Someone who is into software knowledge, technical, risk management, costing. So all these are directors. They can become directors in the company, so they should have expertise knowledge of the two. So in continental Europe, boards have a two-tier structure in Europe, in which the independent directors serve as a supervisory board. That means they always oversee the management comprising inside data. That means the inside board of directors are kind of, monitored or kind of supervised by the independent directors. That is a very strong check on the inside directors. Typically, board members are elected for a specified term. Yeah. So typically board members are elected for a specified term, example annual. So see the board, that suppose there is a board, it has like 4 or 5 directors, maybe let's say 12 directors. So they may be elected for a specified term, that is 1 year. In a staggered board, only a fraction of board is elected each year. That means there are 12 board members, right? Out of that, only 4 members will be elected in a particular year. Next 4 members will be elected in next year. Okay, that is the concept of staggered board. So this staggered board, why they do, they elect only a fraction of board each year to save the company from any kind of hostile takeover, right? So you may be having some like doubts regarding, sir, what is this hostile takeover? What is this staggered board? How is that possible? How is that happening? So like for that, I will send you a link right now. Okay. Or else we will just discuss that staggered board right now. 2 minutes. Just a second. 'Hello'.
Yes, sir.
2 minutes. So here I'm saying that Twitter does not want to go with Tesla. Okay, they are against. They are what they are like. What they have. The thing is they are against Tesla acquiring them. They don't want to be under Tesla. Okay, or be managed by Tesla company. So they if they want to save themselves from a hostile takeover where Tesla is swiftly buying all the stocks or shares of Twitter, which is an indication that Tesla wants to acquire Twitter, okay, by buying lot of shares in the market. So then they get an indication that now they are on the verge of a hostile takeover. So they can utilize this staggered board as one of the strategy or defense strategy against such hostile takeover. So how would they do that is company A is using staggered board of directors to govern company. So now they have this staggered board, right? Not a normal board. So the board consists of 12 directors who can serve, who each serve a 3-year term. So board has how many directors? 12, and they have 3 years term. So 4 directors are placed into each class. You can see class 1, class 2, class 3, resulting in class 1, class 2, class 3. In addition, elections are held every year. Therefore, staggered board of the company would look like this. So first year 4, second year 4, third year 4. Okay. Then again, next election, again, the class 1 will be in the 4th year and the class 2 will be in the 5th year. Like that, it will be going on. Now compare this to another company, company B, which uses a normal board of directors consisting of 12 directors who each serve a 3-year term. See, 12 members in first year and second year or 4th year, whatever. Their first year 4 were selected and 4th year 4 were selected. Here first year 12 and 4th year also 12. So staggered board as a takeover defense, a staggered board is very important takeover defense. Let us determine the implications of a hostile takeover of both company A and B. Let's say some XYZ company wants to acquire company A and then some XYZ company wants to acquire company B. Then how they can save themselves? So company C thinks that it can run company A more efficiently, like Tesla was thinking that they can run Twitter more efficiently, and thus attempts a takeover. To gain control of company A, company C will need a board majority, of course. Right? In a staggered board, company C will only be able to take over 4 seats per election. Correct? If company C manages to take over all the seats in that election, the company will fail to achieve a board majority, only acquiring 4 seats out of 12 seats, because more than 4 seats is not possible. Therefore, it will take company C an additional year to acquire a board majority and take over the target company. That means they have to wait for 3 years. Till that time, the company A can save themselves from such kind of hostile takeover in any of the ways or means, right? Now, company C thinks, like in case of company B, they can acquire or they can get a board majority, right? So company C thinks that it can run company B more efficiently and thus attempts a takeover. To gain control of company B, company C will need a board majority. In a normal board, company C will potentially be able to take over 12 seats per election. Therefore, company C will be able to secure a board majority and swiftly take over company B because they can do that, right? So the additional time required to control company A serves as a takeover defense for rapid takeovers because they get 2 years more, right, to save themselves from any kind of takeover, right? Hello, did you understand? Hello.
Yes, sir.
Fine. Bhargav, did you understand? Hello. Where is Bhargav? I don't know. Okay, Bhargav, are you hearing what I'm saying? Yeah. Okay. So that is about staggered board. I'm sending you the link. You go through that link today. Okay, now, yeah. We have certain more topics. Yeah. Senior managers, I already explained you about senior managers and what senior manager, what we can expect from senior managers, what we can expect or employees expect from the company in which they are working, suppliers, customers, governments. Already have given a lot of details. Customers want good quality products, governments want taxes, suppliers they want timely payments, and also they would always like to maintain a like relationship with some clients or some kind of customers who like pay them like timely payments, and also like you know they always want to deal with a solvent firm, right, or the firm which has good financial strength. So all these factors have been discussed. Only one factor, this also I have discussed with you right now, but we can discuss this in details tomorrow. Okay, I'm running short of time. I have one more session right now for some other students. So this one small topic we will discuss tomorrow. It will take 10 minutes time, not more than that. And then tomorrow we can take up done with this. Just a second. Okay, I will wind up this right now only. No problem. We have time, right? It's not. No, it will take 15-20 minutes. I have like session right now. Otherwise, I would have finished. So, okay, we have done this, right? We have done this. We can do this tomorrow. So these two topics would be done. And then I will start the next topic, corporate governance. One class is enough. And this is done working capital. We can go for capital investment and capital allocation. Okay, fine. This week we can target some 4 or 5 topics from this. Okay, thank you.
Thank you, sir.
Yeah, thank you.